All right. We'll get everybody in. All right. Rob, you have a very different background this week. While we get everybody in, can you tell us where you're at?
Little place in Truckee, California.
Truckee,
No,
California.
Truckee was an Indian chief's name uh, who did not own slaves, so the odds of them wanting to change the name Truckee are small. Sorry, had
Okay.
to go there. Had to go there. No, it's north of Lake Tahoe, near Nevada and California.
Okay. All right.
So you're in Austin.
And I'm in Austin. Yep. Jeff, you're in Philly,
Yep.
right?
Yes.
So we literally have all the points of the country like touched right now. We got East Coast, West Coast, Central. I love it. Three different
So
countries.
Jeff, are you in Philadelphia, or some suburb?
Just outside in Montgomery County, Pennsylvania, not New Jersey.
All right.
Okay. All right. Well, I'm going to go ahead and kick us off and get started. So welcome, everybody. I'm Melissa Langdale. I'm the president and COO of the Mortgage Collaborative. As always, joined by Rob Chrisman, and this week's very special guest is Jeff Rosato at Nationwide Mortgage Bankers. Jeff, thanks for joining us.
No, thanks for having me on. Really excited to be on with you guys, talk about everything capital markets related.
I love it. You and Rob are probably going to nerd out for a little bit, which will be fantastic to watch. We, just to give everybody a little bit of a pulse of who Nationwide Mortgage Bankers is, why don't you share a little bit of who you guys are and what makes you guys different?
Yeah, so we were founded in 2011, but things really started getting interesting and taking off in 2018. From 2019 to 21, we were ranked as the fastest growing mortgage lender by Inc. 5000 for 3 years in a row. So we're a distributed retail business model based in New York, but and we do have like a large concentration of our volume in business in New York. But we've expanded nationally. We're licensed in 47 states and territories currently. So Richard Steinberg is our founder and chairman, and his vision for NMB is to continue expanding nationally, become like the biggest, best retail shop in the country, but maintain what made us successful to begin with. Our values and our culture, our great service. Basically, it's like we want to be the biggest and best national retail lender, but at the same time, maintain like that small company, small boutique kind of feel with like those good service levels. And then I started here at the end of 2020. So I've been through the cycle of like really low rates and really high volume. And then more recently, the exact opposite. And I'll say, during the lean times past, 18 months or so, we've done a great job at retaining our top producers, and at the same time, recruiting and adding new branches, new loan officers, and then streamlining our processes, improving our technology and our marketing. So really taking advantage of the downturn, reinvesting back into the company and into our people, so when the market does turn, we're in a better spot than we were before. So that's why we're really optimistic about 2024, where this is the turnaround year. January and February don't look to be the best months, but we think by March we should be shooting back up to where we want to be again. So really optimistic about 2024.
That's great. You've invested in one thing that I'm really interested in, that I think probably a lot of our listeners would be interested in as well, and that's your Ginnie Mae ticket. That is no easy feat to get through. And you guys in 2022, I think, were one of only two lenders across the country that Ginnie approved. So would love to hear your thoughts on, number one, why that's so important to consider for a company, but then also why the heck is it so complicated to get through that process?
Yeah. Well, first, I mean, everybody, you want to have as many execution options as possible. You want to have your agency approvals. You want to be able to deliver directly to the agencies. You want to be able to do your own, Ginnie Mae securities for better execution if it's there for you, and if you really have an appetite to retain servicing. That's the other part. If you don't have an appetite to retain servicing, then don't bother with it, right? As far as the application process, luckily for me, I wasn't too heavily involved with the process. But I think one of the biggest things that people, aside from capital markets professionals, don't realize is that like Ginnie Mae really isn't an investor, right? Like they're the insurer of the bonds that you're going to securitize and then sell to broker dealers who really are the investors. Um, so it's not like just getting signed up with like a correspondent investor, like name any big one, right? Where you just fill out an application, you load their pricing into your engine, you go through the seller guide, make sure you have like your delivery all set up, and boom, you're off to the races. It's really more focused on having a platform set up for you and making sure that the technology is all there, in order to be able to do the securitizations that you're then going to sell to other investors who are, broker dealers who are going to bid on your pools. So there's a lot of forms, Ginnie Mae's loves their forms. So everything has to be done with a form, and it has to be signed by, multiple people, all wet signatures. So you got to circulate forms across the country, and everything takes time. Um, and then the security on the technology part of it too, there's you have to assign different roles to different individuals within your company. You have to have security tokens set up. So the system access just in itself is a lot more complicated than just, getting a username for a correspondent investor's website. So, and then everything just takes time, right? Like I know Ginnie Mae probably doesn't have that many employees, right? They're probably like the largest government agency with the fewest amount of employees. So everything just takes time. So I know for us, we had originally applied, I think at the end of or the beginning of 2021. I think at one point we may have like paused on the application and then started it again in 2022. And at the end of 2022, we did finally get the approval, which was great. Now we hadn't really used the ticket much. Like you have to either service a Ginnie Mae loan or pool, or you have to issue a new pool every 12 months in order to keep the approval, right? So we have done some pools just because we have to prove out the process, and kind of, figure out what we need to do better the next time for the next pool. But we really didn't have an appetite for government, retaining government servicing or conventional servicing for that matter in 2023. So the valuations that we're using for our servicing are nowhere near what correspondents are paying through their mandatory bids or just their regular best efforts pricing. So the opportunity for us really hasn't been there to use it as much, but we have it. We've proven out the process. We've gone through all of the setup so that when rates do come down a little bit where we have more of an appetite to retain servicing, we already have it ready to go. We just have to dust it off and kind of remember what we did the last time. So.
And Jeff, you had to, excuse me, you had to have somebody on your staff with, is it Ginnie Mae servicing experience before they would approve you?
Yeah. So, oh, excuse me. Sorry. Yeah. So you have to have history of servicing Ginnie Mae pools. Yeah. So we've had in our servicing we use a sub-servicer, but we do have an interim servicing department. So we were able to check that box.
And without naming names, unless you want to name names, did you handle the Ginnie Mae application process in-house, or did you farm it out to a consultant?
Well, we did it all in-house, but that's a good. But we did heavily consider bringing in a consultant to help us with the process. When we paused the initial application, before we restarted it, there was serious consideration about doing that, but we decided to move forward on our own, and we plowed through it.
Yeah. Well, congratulations on that.
Yeah. Thank you.
That's-
Um, I wanted to ask you about, and it's not so much nerding out, Melissa, but it's a question that people wonder about. I mean, it seems like everybody kind of knows what a loan officer does, and everyone kind of knows what an underwriter does. And but the question comes up about capital markets. What does the capital markets person do all day? And when I used to run capital markets and hedge pipelines and deal with warehouse banks and all that, I'd wake up around 8 or 9 in the morning and have, steak and eggs for breakfast. And then the driver would take me to my jet and I'd, go somewhere exotic. And while I was in the air, put on some straddles or hedges or whatever I was doing. And then, go sit on a beach.
Right.
Uh, Actually, no, it was like I'd get up at 4 a.m. and I'd get out of bed and I'd probably step on one of my kids' Lego pieces on the way down the hall. Anyway, uh, what do you do every day? I mean, is it glamorous? Is it the same thing? I mean, what have you put it? What have you done today? You
Well, I think a lot of people think that it is glamorous, and I'm just sitting here like staring at like the market and reading articles about like what the market's doing all day, right? Like, but it's really not. What I would say the biggest thing is that in my world, like everything is urgent and everything is time sensitive, right? So like when the market's open, there's certain things that I need to get done during that day, right? And everything is very time sensitive. So I can't just drop what I'm doing and hop on a phone call or join a meeting with somebody. It's like things need to get done when things need to get done. So like today, like I first thing in the morning, every morning around 7 o'clock, I run my pipeline, take a look at my hedge position, kind of look at what my expectations are for the day. Like if I think, well, like this morning with the employment report. So, be ready for some market reaction there, do I think it's going to be like a heavy lock day? Do I think it's going to be a light lock day? Are there other things that I have responsibilities for that are going to take time away from me during the day and kind of prepare my team for that? Then, what back, years ago, the next thing would be like getting all your rate sheets like published and put out for the day. The way pricing engines are today, you don't really have to do much of that now. You just kind of have to check to make sure that everything's there and everything is what it should be. So that's a little bit better. The next thing I do is like I try to trade loans every day. So I like to get my bid tapes out like as early as possible. So bid tapes are going out around 7:30, 8 o'clock, because I like to get them back early, because everything takes time, right? So like, I got to get all my bids back. Then I got to run everything through my best X model. Then I got to hit the bids and I got to wait for them to confirm the bids. Then I got to check my hedge again to make sure that, and all of that needs to be done timely, right? Like I can't go and trade $10 million worth of loans and then not look at my hedge position for like the next 2 hours. I have to do it right away because if the market moves, then I just lost money on that trade, right? Um, and then, aside from that, it's phone calls from loan officers and sales managers. There's problem loans, things get escalated. So it's like, the phone and emails are going off the hook all day long. And then there's other responsibilities too, right? Like there's like internal company meetings, product development type stuff, just, management meetings just in general. And then dealing with investors. We have many investors here. If I told you how many investors I'm approved with, you'd probably puke. But you have to deal with all those investors and keep them happy. And, issues arise. You have, you get hit with some EPOs or you have some pair offs and, bills aren't being paid and just not because you're not trying to pay, just because you haven't gotten to it yet. So there's a lot. And while all of this is going on, there's certain things that come first when we're talking about trading and hedging, because it's all very time sensitive. So I wish I could just, sip mimosas in the morning with my steak and eggs, and fly out to the Reno to see you, but there's just too much going on.
Yeah. So I happen to have a special guest. I have the
Brett
CFPB's.
Myrtle?
the CFPB's biggest, you know, I don't know. She hates the CFPB, but do you ever deal with uh, uh, regulators? Do you ever deal with vendor approval? Like if, like, let's say the company wanted to add a new AMC or add a new CRA or add an LOS. How involved do you get either with regulators or with vendor management?
Vendor management, really not so much at all. We have a vendor management, our vendor management team who handles that, unless it's my vendor, right? Like if I'm, going to switch my pricing engine, or I want to add a new vendor for something, then obviously I'd be involved with it, but not typically. For regulators, our great compliance department takes care of all of our audits, but if there are questions that arise that are secondary marketing related, of course they pull me right in, and I'll like dig right into whatever the issue is to get the answer to whatever questions are coming up. But luckily, no, not very much. Now, on loan level compliance, we're very heavily involved, especially in the past 18 months environment that we've been in. It's really become a big part of secondary, just because of where APRs are, and passing APR tests, and ATR QM points and fees tests really became difficult over the past year. So on like a loan level basis, as far as like compliance goes, yeah, but as far as like regulators and audits, not so much.
I have
You
a
know,
question.
oh, sorry, Melissa, go ahead.
Sorry, Rob. Um, you mentioned that Nationwide Mortgage Bankers was on this track of, exceptional growth. A big part of hedging your pipeline, though, is understanding your pull through. So how do you consider pull through as you're going through and adding all of these new branches and all of these new areas, right? To me, that seems very complex.
So in most hedge advisory firms, whoever you're going to use, have pull through models built out that you back test, usually on a quarterly basis. You can do it more than that if you choose to, and you could get really granular and crazy with how you're looking at pull through. I mean, down to like the LO level.
Yep.
I've always been a believer of keeping it simple when it comes to that, and even with the amount of like loan statuses that I use, like you can use 20 different loan statuses and have different pull-through values associated with all of them. Really, there's probably, in all actuality, depending on how your company's set up, like 5 or 6 like real key pull through levels from like a milestone perspective that you really need to be watching. So I do look at pull through at least on a monthly basis, usually make changes to the model on a quarterly basis. But I don't go crazy with all of the different ways that you can look at it. I try and keep it as simple as possible, and it's always worked out well for me.
So given what you just described, you're dealing with on a daily basis, weekly basis, monthly basis. The last thing you or really anybody in capital markets need is interest rate volatility. I tell people, a stable rate environment is great. Rates slowly going up, rates slowly going down. Fine, we can deal with it. But it's when it's like this that really the hedge costs go up, and then you have to explain to senior management why the hedge costs are going up. You have renegotiations and extensions; those increase, and so this kind of environment, we certainly saw a fair amount of interest rate volatility last year. So far, last few months, it's been relatively quiet. So do you agree? First of all, do you agree with that? And second of all, does a relatively stable environment allow you to focus on other areas?
Yeah, well, I absolutely agree. And I always kind of say, like, as a capital markets guy, like I don't really care, and should I have to care of which direction rates are going in, right? As long as they're kind of going in a smooth line. Like my job is to take in new locks and then hedge the pipeline to maintain that margin, right? And just and break even and maintain the margin that we had from the day the loan was locked, right? So it doesn't really matter to me which way rates are going. But the volatility is the real killer, and it's not. And so your hedge costs, you know, of course, are increasing, and really there's the basis risks there too. That was like the real killer, you know, back at the beginning of last year, because as mortgage-backed security prices are going down, the pricing that you're getting from your investors is probably deteriorating more than the securities that you're using to hedge with. So that's the basis risk that just makes the cost of hedging go through the roof. And there were periods with the past 2 years where like I seriously considered just not even hedging anymore and just going straight back to best efforts and just having my guys like lock every loan like directly with an investor, because it just was getting out of control, you know. And so yeah, the past, you know, month has been very quiet, other than today. Today was actually the first day that we've really had a big move in either direction. But yeah, it makes it, you know, when obviously when your P&L is looking good and it's consistent and you don't have wild fluctuations day to day, that kind of frees your mind up to focus on other things. Absolutely.
Yeah, there are, there are people out there who, uh, I try to explain capital markets to, and they, maybe they don't know the difference between a basis point and a pencil point. But the idea that I try to get across is capital markets people aren't really there to make the company money. It's not like you're the big hitter, the big swinging, guy,
Right.
the alpha male. I mean, you are there to protect the margin day in and day out. No more, no less. You don't want to, protecting the bottom line. Philip writes, just like kind of watch the door, keep an eye on things and keep things steady. And nobody wants their capital markets person to be taking chances or betting on the market or thinking, well, rates are going to go down, or rates are going to go up, and taking a position in the market. I mean, that's how you lose companies.
Right. Yeah. I think there's plenty, you know, stories of companies just being blown up by their capital markets guys, right? Like doing exactly what you're talking about. There are times where you can, on a very small scale basis, like if I'm trading loans and I'm watching the market move, down, I might wait, a couple minutes or, a half an hour to see if it goes down a little bit more until I lift some coverage, make a little bit more on that trade, but overall big picture, yeah, if you're like trying to make money for your company through your capital markets department, that's a horrible idea.
Sam has a good question in the chat that I want to make sure we touch on. He says, when you do pair offs, do you go first in, first out?
I do, yeah.
All right.
Yeah. I like to try and keep, now we're talking about like pairing off like TBAs, pairing off hedges. Yeah. So I like to keep things moving along. Like when you look back at your hedge performance, like you really got to look at like probably 90 days at the shortest, because that's kind of like the time frame that you're looking at. And things can get the timing can kind of get out of whack. So I do always like to have like, first in, first out when I'm lifting, unless there's some cases, like if you're close to margin calls with like one dealer, you might want to strategically, either lift or add more with them or somebody else to try and avoid a margin call in the short term. But in general, yeah, I'm always first in, first out.
That's a good question. We, from a logical perspective, it doesn't matter, right? In theory, you're going to have to, you would buy something back or not. Sometimes it is cosmetic, or to avoid some kind of margin issue. but really it's like, well, let's just pick this pool to buy back, or pick this hedge to buy back, uh, and go about our business. So Jeff, do you think that the, uh, a few years ago, they rolled out the UMBS, a combination of Fannie Mae and Freddie Mac. Any upcoming developments that you see in the securitization market that may impact folks on this call? And you
Not
can say no.
No, 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 unless you're telling me there's something I should know about and I don't.
Now he's
No.
curious, Rob.
No, 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 no. It's an interesting thing. I'm supposed to have a call with a guy named Lou Ranieri. And Lou Ranieri is the father of the mortgage-backed security. So I'm looking forward to that call at some point. But really, you could have left the industry 10 or 20 years ago and come back today, and it's still, the securitization process is almost identical. I mean, there's some tweaks and some paperwork and some processes that are different, but basically it's the same entity that's being used to hedge a pipeline. So yeah, I haven't heard of anything new and exciting going on. So Jeff, you're not missing anything.
Okay. Good to know.
Well, maybe if we look into the future and what's coming, right? If or when rates do drop, there's going to be renegotiations, there's going to be EPOs, right? There's going to be a couple things that, lenders are going to have to deal with. What would you suggest that people do now to prepare for what's coming in that regard?
Well, for EPOs, I mean it's kind of part of the business in a declining rate environment, and I don't really know if there's any way you can prevent them, even with like prepayment penalties. If a borrower wants to pay off like bad enough, they're going to, right? But like what you don't want to do is shoot yourself in the foot, if for a sales team or a particular LO, you don't want to go back to a past client without being aware of the EPO risk. Because in most companies, if an EPO is, you do get an EPO, you're gonna go back to that branch or that LO and recoup that premium from them as well. So what you don't want to do is shoot yourself in the foot. So the sales teams need to be aware of what the policy is, so that they're not, just to avoid them on their own. And then we look at our pipelines and say, like, for all loans that we closed in the past 12 months, let's look and see if we're past our EPO periods, and then tell our LOs, hey, these borrowers, their current rate is 50 basis points higher than like the current rate. Let's reach out to them, and that's all internal, right? Like that's not, we don't have to deal with like trigger lead rules and all that, right? Like these are just our own borrowers that we've worked with before. So there's like some opportunity to be proactive when rates are dropping, but you just have to be aware of like the risk of the EPO. And then for renegotiations, like I'm all for renegotiations and I'll look at them all day long on a case by case basis. The thing is like when rates are going down, there's a hedge loss associated with that loan. So you don't want to lose the loan and make nothing and then still have the hedge loss. So you want to make at least something on the loan, right, to offset the hedge loss. So, but I don't just, approve them willy-nilly. Like you have to look at other parts of the story, right? Like how far along is the loan in the process? Is the loan's clear to close and it's going to close next week? Then absolutely, let's do whatever we need to do to keep the borrower, But if the loan was locked, 2 days ago and we just had a big move, and it's been locked for 2 days, the loan is in like not even in an approved status, and there's still, 20 days left on the lock. Even if like, current market was better by a point, like I'm still not going to approve a rate reno on that one.
Every loan officer on this call is going, no, I want you to do the opposite. I've already got them clear to close. They're not going anywhere. They're closing in 3 days. Same thing on the
Well,
20-day mark. They're like, no, I need to keep them. I don't need them to go to another loan.
Yeah, well, and then like you have to like if you need to rely on the loan officers to know the seriousness of the borrower too. Like because if like a borrower is like cleared, they get another offer and they're going to have to wait another 20 days or 21 days for that other lender to get them closed, then and I think most loan officers are able to kind of gauge the seriousness of the customer, and then we'll need proof too, like show us like an LE or an offer, something from the borrower showing that they're actually getting this deal from another lender.
Yeah. All right. Well, we are all up at time today. Jeff, thank you so much for sharing your cap markets knowledge with all of us, and nerding out a little bit with Rob. And it was fun to hear, and great information. Next week we will be back here as always. We have Skylar Olson joining us. She's the chief economist at Zillow. So we're going to have an economic update. We're also going to have a little bit of fun with our upcoming Louisville conference. So be prepared for a little fun derby action and really fantastic information on the economy and what's coming. And hope everybody has a fantastic weekend. Jeff, thanks again for joining us.
Thanks for having
Yeah,
me.
if that means Melissa's going to dress up like a Southern belle.
We'll see. All right, guys, have a good weekend.
Enjoy the weekend.